Is Suffield still facing an inventory challenge? Are prices still on the rise? Get the answers in this month's Suffield Housing Market Update. But first, let's take a look at what's been happening in Suffield. In September in Suffield, 11 homes were sold, and that's down 27% from September of 2022. 6 new listings came on the market, and that's down 14%. The sales price to list price ratio was 104.98%. and that's up 5% from 2022. And the average price per square foot was $233, and that's up 17%. The September average sale price was $526,000, and that's up 13% from 2022. And the average days on market was 155, and that's up 187% from 2022. So that 155 days seems like a high number of days on market, especially considering our inventory challenges. So I took a look at the data further and broke it down by price range. You'll see if I look at the average days on market between 0 and 500,000, the average days on market is actually 27, and that's down 57% from 2022. And then when I take a look at $500,000 and above in Suffield, the average days on market is 261. And that is up 553% from 2022. So it's safe to say that houses in the higher price ranges in Suffield are not moving as quickly as the houses below $500,000. In Suffield, in all price ranges, the month supply of inventory is 2.73 months, and that's up 46% from September of 2022. And again, when I break that down, you'll see that the month supply of inventory below $500,000 is at 1.4 months. And when we go above the $500,000 price range, it jets up to 3.83 months. Now, how that works is 6 months is considered a balanced market. So anything more than 6 months is a buyer's market, and anything less than 6 months is a seller's market. So where the inventory sits, we're very much still in a seller's market. But if you'll notice, as we get into the higher price ranges, and it gets even higher as we go up in price, we lean more towards a balanced market, or in some cases, depending upon the price range, even into a buyer's market. Now, we talked about last month that the number of new listings coming to market in August was at an all-time high for August. And that's just 1 month's data, but historically, that's going against the seasonal trend. So we are watching those numbers closely to see if that's going to be a sign of more inventory coming to the market and a sign that homeowners are ready to make a move. So where we've been focused in watching is how the higher interest rates are impacting our already challenged inventory levels. However, there may be opportunity in certain segments on who just may be ready to make a move. We know that the vast majority of people have very low interest rates right now. As a matter of fact, 70.7% of all current mortgages are lower than 4%, and over 90% are lower than 5%. And at a 7.5 environment, maybe even closer to 8, homeowners may not choose to sell because they don't want to buy another house and have to take a mortgage that's twice the percent of what they currently have. But if we take a look at that and really analyze it, we'll know that sure, that's probably true. Anyone less than 3%, they're likely not selling unless there's a life event that happens that they need to sell. And if they have under a 4% mortgage rate, between 3 and 4, they're probably not going to sell. Between 4 and 5, they're going to have to think about it hard before selling. And then if they have between a 5 and a 6, or even in the 7s, they're more likely to sell. They're not going to let the rates hold them back. And obviously, if they're over 6%, they're probably going to go ahead and just do it. However, we take a look at these numbers, there's an exception there. If we look further into this, we can see that about 1 in 4 U.S. homeowners, 26%, say that high mortgage rates would not impact their decision on when to sell their home. And if we go to the 26%, 43% say it's because they would not need a mortgage to buy a home. So there are 1 in 4 people saying that mortgage rates won't impact whether or not they're going to sell their home. And that actually came to me as a surprise. And of that 1 out of 4, 4 out of 10 are saying they don't need a mortgage to buy a home. So here is what I think the experts are saying. If we break down that 43%, this is what we realize. 35% are baby boomers, 23% are Gen Xers, and then you see the numbers drop off. Why is that? Because the baby boomers and the Gen Xers have what? Plenty of equity. And let's take a look at that a little bit closer. This is the amount prices have gone up in the last 5 years in this country. If you look down at the bottom right to the bottom middle, the national average is 57.3% in 5 years. That means if someone had a $400,000 house 5 years ago, that house is worth $600,000 right now. So they would have an extra $200,000 in equity in addition to whatever they paid off over the last 5 years of their mortgage. But if we go back to 1991, so 32 years back, we can see that the national averages, prices went up almost 300%. The homeowners that bought their house 30 years ago, they're sitting on a tremendous amount of equity. And these are the homeowners that are saying, mortgage rates don't matter to me. I can go ahead and buy because I have enough equity. So how much equity do they have? 38.7% of Americans today own their house free and clear. 30% have more than 50% equity. Meaning if they own a $400,000 house, they have at least $200,000 in equity. And then you look all the way around the corner, even if we go down to 0 to 9% equity, that's minimal equity. That's only less than 2% of the people in the country. And people that are worried about negative equity, that's less than half of 1%. So there is tremendous equity in our country. As a matter of fact, CoreLogic in the latest equity report said quarterly gains added almost $13,900. The average U.S. homeowner now has about $290,000 in equity. That's pretty incredible. So what does that mean? Well, homeowners with this type of equity have 3 major advantages in the market. Number 1, many will have the ability to buy and be an all-cash buyer. They don't have to worry about a mortgage because they're not taking a mortgage. Secondly, if they have a lot of equity, they have the ability to give larger down payments. That means they'll get more favorable interest rates, lower private mortgage insurance costs, and ultimately reduces the overall cost of a mortgage. And number 3, as Americans grow older, many will need more and more help in regard to assisted living residents, and homeowners with a lot of equity could make that move now. Okay, so now let's take a jump to current home price appreciation because that is super important. First of all, from the Wall Street Journal, home prices aren't falling anymore. A surprisingly quick recovery suggests that the residential real estate downturn is turning out to be shorter and shallower than many economists expected. As mortgage rates soared last year, many experts were predicting that prices would fall 20, 10, 8, 5%. And while we did see a small correction last year, home prices did come right back again. From January through August, housing demand stabilized, resulting in relatively stable home prices. By August of 2023, national resale home prices fully recovered from the declines experienced in the second half of 2022 and now exceed their April 2022 peak. We had that fall off and then come back, according to Freddie Mac. Overall, it appears the reduction in supply has outweighed the decrease in demand. Thus, house prices have started to increase, even as sales have fallen. Now let's take a look at the data on that. Look at Case-Shiller, the FHFA, and the CoreLogic report. What happened at the beginning of last year is that prices appreciated way too high, way too much greater than they should have. There needed to be a correction, and there was. And now appreciation is much more on the historical norm. So those are 3 indexes. Here's another 3. They're all showing the same thing. As a matter of fact, the FHFA shows that in every single region of the country, prices are up. And if we go to Case-Shiller, every single of the 20 cities they cover, all 20 cities are up. High mortgage rates have slow additional price surges, with monthly increases returning to regular seasonal averages. In other words, home prices are still growing, but are in line with historic seasonal expectations. So what does that mean? If we look back at the last 49 years and we average it out, this is how much prices have gone up each month. So what we see is the beginning of the year, prices go up higher, quicker. The appreciation accelerates as we're going into the prime buyer season. And then as we hit summer, the appreciation decelerates. We're not talking about depreciation. Those bars would be in the negatives if we were talking about depreciation. What we're talking about is that appreciation decelerated. Now, by the end of the year, those bars are so close to 0. Maybe one of them is going to slip to a red bar at the end of the year, but that's not going to be a big fall off in prices. We didn't have the massive appreciation this year that we saw last year, but if we take a look at what we can see, We did have a little extra appreciation, and then prices caught up as we headed into the spring market. But now we're getting back to normal numbers again. Some people are suggesting, nevertheless, home prices are still expected to re-accelerate and reach mid-single-digit growth rate by the end of the year, according to CoreLogic's latest HPI forecast. So they're saying we're still going to be good. We're not going to be anywhere near the red. What I'm going to share here is 6 of the year-end forecasts that just came out. American Enterprise Institute, Zillow, Fannie Mae, the Home Price Expectation Survey, Mortgage Bankers Association, and NAR. NAR is the only one that is projecting that prices will be less at the end of this year than they were at the end of last year. Everyone else is seeing that prices are going to be going up. The average of all 6 of them is 3.3%. So what are we going to have this year? A little less appreciation, but that's a good thing. After 2 years of crazy price appreciation, prices are settling in and wages are going up. And though both of those things have an impact on affordability, they're nowhere near the impact that mortgage rates have. So mortgage rates have to moderate in order for affordability to be impacted in a big way, but we are hopeful that we're going to see that moving into the future. With housing prices, if appreciation moderates at the normal numbers, and if wages continue to go up, mortgage rates will eventually moderate. So what are the major takeaways? Well, experts are predicting that mortgage rates will come down. We're yet to see that happen. And inventory is the key thing for us to be watching here, because while rates can impact people's buying power, a large percentage of homeowners are sitting on tremendous equity and are not impacted by higher interest rates. And experts are predicting that we're going to be appreciating at normal seasonal levels and that prices are going to hold strong. And that's great news for our home sellers out there. Want to see what the equity looks like in your home? Reach out to us for an in-depth equity review. Our information is in the description below. Or feel free to use our Salerno Team Home Values tool if you want to take a look at an estimated value of your home. Thank you for watching and for your likes. And if you found this information useful, please be sure to hit that subscribe button below. Or if you have a friend that you feel would benefit for this information, feel free to hit that share button. All right, this is your October Suffield housing market update. See you next month.